Hi, I'm Yashna from Aliceblue. In today's video, I will be talking about commodities trading. So what is commodity market? A commodity market is a physical or virtual marketplace for buying, selling, and trading raw or primary products, and there are currently about 50 major commodity markets worldwide that facilitate investment trade in approximately 100 primary commodities. There are four types of commodities: metals, such as gold, silver, platinum, and copper; energy, such as crude oil, heating oil, natural gas, and gasoline; livestock and meat, including lean hogs, pork bellies, live cattle, and feeder cattle; agricultural, including corn, soybeans, wheat, rice, cocoa, coffee, cotton, and sugar. How can I start trading in a commodity? So before you start trading in commodities online, once you have selected the commodity broker like Aliceblue Commodity and you receive an approval for trading, the next step is to fund the account. It is up to the individual as to the amount of funding or account size when you open an account. So how does a commodity exchange function? A commodity exchange acts as a portal or a common place where traders can buy and sell commodities. Such exchanges enable seamless trading, eliminate the need for middlemen, and allow the market to fix a price that is driven purely by demand and supply of the product. What are the major factors that impact commodity prices? First being supply and demand, then inventories and stocks, currency, and inflation. Commodity trading has different types of derivatives: forward contracts, futures contracts, option contracts, and swaps. Commodity market. What are the different commodities that are being traded currently? It includes crude oil, sugar, gold, corn, copper, cotton, natural gas, RBOB gasoline, soybean oil, heating oil, wheat, soybeans, silver, and cocoa. So why should you trade in commodities? The reasons are because of leverage, liquidity, diversification, hedge against inflation, physical gold, assurance of purity, transparency of rates, and safety. A brief introduction on the Indian commodity market. The history of organized commodity derivatives in India goes back to the 19th century when Cotton Trade Association started futures trading in 1875, about a decade after they started in Chicago. Over the time, derivatives market developed in several commodities in India. Following cotton derivatives, trading started in oilseed in Bombay, raw jute and jute goods in Calcutta, wheat in Hapur, and bullion in Bombay. Currently, there are 24 commodity exchanges in India. The following are the three main national level exchanges: Multi-Commodity Exchange, National Commodity and Derivative Exchange, and National Multi-Commodity Exchange of India. Commodity trading, every beginner should know about. How do I choose my broker? What is the minimum investment that is needed? Brokerage and transaction charges. How to give delivery or settle in cash? Who are the players in commodity derivatives? Is stamp duty levied in commodity contracts? And what are the stamp duty rates? The difference between trading in stock and commodities. Equity is one among the financial product that refers to the shares that are sold by the registered entity on a stock exchange in the stock market. Similarly, equity is an investor's asset that represents a part ownership of desired companies held in a business. While investing on commodities refers to raw material or primary agricultural product that can be bought and sold, for example, like copper, gold, silver, biofuels, coffee, sugar, wheat, cotton, etc. These commodities are not physically traded on an exchange, but instead traded through commodity futures and forward contracts, and also depends on the value of the commodity at the time of trading. How does commodity trading work? The commodities markets work just like any other market. It is a physical or virtual space where one can buy, sell, or trade various commodities at current or future date. One can also do commodity trading using futures contract. A futures contract is an agreement between the buyer and the seller, wherein the buyer promises to pay the agreed upon sum at the moment of the transaction, when the seller delivers the commodity at a pre-decided date in the future. Commodity options trading. A contract permitting the option buyer the right, without the obligation, to buy or sell an underlying asset in the form of a commodity such as precious metals, oil, or agricultural products at a designated price until a designated date. The various commodity jargons that are used are arbitrage, carry forward position, cash commodity and cash settlement, derivative, clearing and clearing member, hedging, mark to market, convergence, delivery and delivery period, speculator, and trading lot. The various commodity indicators include moving averages, moving average convergence divergence, relative strength index, and stochastic. Commodity prices. Commodity market prices that are associated with commodity purchasing. Commodities can be priced on weight or by standard unit. Prices are determined by the open market supply and demand. The bullion market. Bullion is gold, silver, or other precious metals in the form of bars or ingots. Typically, bullion is used for trade on a market. The word bullion comes from the Old French word bouillon, which meant boiling and was the term used to describe the activity of a melting house. MCX India and the factors affecting it. The various factors include risk and return, trading, clearing and settlement, demand and supply, demand curve, global and domestic economy, economic growth, inflation, geopolitical concerns, extraordinary events, and speculation. The 5 commodity trading strategies are range trading strategy, trading breakouts, fundamental trading strategy, money management, and risk management. Commodity index and introduction. A commodity index is an investment vehicle that tracks a basket of commodities to measure their price and investment return performance. These indexes are often traded on exchanges, allowing investors to gain easier investment access to commodities without having to enter the futures market. The requirements to open a commodity trading account are to have an identity proof, a bank statement, address proof, colored passport size photograph, and cancel check. Online commodity trading, and how do you go about it? To become a commodity trader, one needs to complete certain legal and binding obligations. There is routine process that is followed, which is stated by a unit of government that lays down the laws and acts with regards to commodity trading. A broker of commodities is also required to meet certain obligations to gain such a membership in exchange. So why should you invest in the commodity market? You should invest for the following reasons: for diversification, for inflation protection, for hedge against event risk, for liquidity, for trading on lower margin, and for high returns. Are blue chip companies a safe investment option? They are safe because of the following reasons: for stable earnings, dividend payments, strong financials, diversification, and competitive brand advantage. The drawbacks of trading the 52-week high and low. There is no significance of 52-week low or high in commodities technically, and there is no significance of 52-week low or high commodities fundamentally. The history of trading in agricultural commodity. A commodity exchange is an association or a company or any other body corporate organizing futures trading in commodities for which license has been granted by regulating authority. NCDX was founded as a public limited company in 2003. It too is based in Mumbai. It offers futures trading in 31 commodities. Trading in agricultural commodities is especially popular on this exchange. Its key shareholders are ICICI Bank, National Stock Exchange, National Bank for Agriculture and Rural Development, and Life Insurance Corporation of India. So how does season affect the price of agricultural commodities? The factors are production related, storage and transportation constraints, economic and demand related patterns, costs involved in storage, and seasonality. Why should you invest in rubber futures? For bet on automobile demand, bet on crude oil prices, inflation and weak US dollar hedge, and portfolio diversification. The reasons for the volatility of gold in the commodity market are consumption demand, speculative demand, and demand from central banks. The reasons for the volatility of silver in the commodity market are large and private institutional investors, large concentrated short position, industrial demand, gold prices, US dollar, and regulation in silver market. The safest commodity that first time commodity traders can trade in are copper, crude oil, and gold. What are the factors that are influencing the prices of agricultural products? It includes cost of production, demand for product, price of competing firms, purchasing power of customers, government regulation, objective, and marketing methods that are used. What are the factors that are influencing the prices of non-agricultural products? They are production related, storage and transportation constraints, economic and demand related patterns, costs involved in storage, and seasonality. For more information, do contact us. Thank you for watching and stay tuned for more. If you liked our video, do like, share, and subscribe.